Well, over the last 18 months, I think one of the themes in the Treasury markets is volatility and lack of liquidity. Now, that volatility has eased a bit, here and there, but I think we are entering a period where, from a technical standpoint, we will see increasing levels of short-term volatility, both on the side of the need for additional issuance, but into a thin liquidity market, where from the demand side, your biggest potential buyer in the Fed is not going to be actively increasing their net purchases overall. And I think the ratings downgrade could come into play on the margin as well. The ratings downgrade doesn't necessarily translate into any type of a fundamental risk necessarily in how investors view the safety or long-term ability of the government to pay its debt. But where it could come into play is from a technical standpoint. Now that you have two of the three major rating agencies downgrading it, there could be some funds and some accounts where the governing requirements limits the ability to hold what it currently holds. And so on the margin, there could be some additional selling pressure or an inability to add to the exposure, which again, in a relatively illiquid environment, could cause yields to temporarily show near-term volatility to the upside. But at the end of the day, treasuries will settle into where the fundamental value should be. But in the short term, the technicals would drive any near-term moves.
Very much so. Stephen, really quickly, because we're bang out of time, just in terms of where you think the value should be, where do you peg the 10-year right now in your calculations? I'm not talking about 10-year USD, mind you, in terms of by the end of the year. Are you in the above 4 camp or below?
By the end of the year, we believe it will start to trend below the 4 level. I think longer term, ultimately the trend is going to be lower relative to where we are today. It's how we get there will be a bumpy ride. So in the very, very immediate term, we believe that there is value in 10-year treasuries at 4%. But at the same time, if you're getting 3-month T-bills at 5.5, 5.6, it's really, with the uncertainty at the 10-year, makes it much less appealing on a, let's say, 3 to 6 month time horizon of where do you want to be exposed to.